Well, there's been a lot of talk lately about silver making some violent move into triple digits, with gold trying to drag the whole precious metals space into another gear. So, in this video, we're going to separate the hype from the setup, and you're going to walk away with a much clearer picture of what could actually be changing right now. It is Thursday, April 16th in New York, and tell me in the comments what day and date you're watching from. And real quick, if you value this kind of work, support the channel by subscribing and commenting John A.G. Best. That lets me know you want more of these breakdowns. Now, on the surface, the simple version sounds almost too good. Silver is hanging around the $80 area. Gold is pressing up near the upper 4,800 zone again. The dollar has backed off. Oil is still tied to the Iran story. Big money forecasts are still floating around for gold in the upper 5,000 range. And silver? Silver's the one that people think can go from exciting to absolutely unhinged in a hurry. But here's the thing. When people hear $100 silver, or $160 silver, or even crazier numbers than that, they tend to do one of two things. They either laugh it off like it's internet fantasy, or they get so emotionally attached to it that every single chart wiggle starts looking like the final launch sequence. And I don't think either of those reactions helps you. Because what matters right now is not whether somebody can shout the biggest target. What matters is whether the conditions underneath the market are getting tighter, broader, and more dangerous for anyone still betting that metals are just going to roll over and behave. And I've got to tell you, there are a few things happening at the same time right now that are hard to ignore. First, let's deal with the chart side without turning this into a geometry class. There are multiple long-term and medium-term setups that all point in the same direction. Some traders see a curved base. Some see a continuation pattern that already resolved higher. Some are focused on a breakout and retest. Some are watching the last pullback and saying the market is simply building energy above old resistance instead of failing at it. Different names, same message. The market keeps finding buyers sooner than a lot of people expected. That's the part I don't want you to miss. When a market is weak, rallies look cute for a minute and then get smacked back down. When a market is strong, dips start feeling shallow. Bad news stops doing as much damage, and the price begins acting like it wants higher ground even before the headlines give it permission. Silver has been showing more of that behavior. Now, does that mean the road is straight up? No, not even close. In fact, if silver does eventually make a run at the 100 neighborhood, it probably won't be because the market suddenly became polite. It'll be because the market becomes more disorderly. Bigger daily swings, faster squeezes, more emotional pullbacks, more people getting shaken out right before the next leg. That's usually how these moves work. They don't reward comfort, they reward conviction and timing. And this is where the dollar comes in. A lot of people look at the dollar index like it's just another line on a screen, but that line carries a lot of weight for metals. Over the last stretch, the dollar has backed off to its weakest level in weeks, and that matters because gold and silver don't need a collapsing dollar to run. They just need the dollar to stop acting like a headwind every single day. Once that pressure eases, metals get room to breathe, and sometimes that breathing room turns into a sprint. That doesn't mean the dollar is dead. It means the one-way strength story has cracked. And when that happens while real-world stress is still hanging around, that's when metals start getting interesting again. Now layer on the geopolitical piece. The Iran situation has been yanking oil, inflation expectations, and risk appetite all over the place. One day the market trades the fear. The next day it trades the possibility of a de-escalation. Then it swings back again. Gold pulled back hard during part of that chaos, and yet here it is finding its footing again instead of falling apart. That tells me this market still has hands underneath it. It may not love the path, but it's not leaving the table. Silver gets dragged around by that same noise, but silver has an extra twist. It is not just a fear trade. It is also an industrial metal, which means it can get hit by growth worries and then rip higher when monetary or supply concerns take over. That split personality is exactly why silver can look sleepy one week and completely feral the next. And based on recently published numbers, the physical side still has a pulse strong enough to matter. This is important because there's always this lazy argument that says, well, if paper volume is huge, then nothing in the silver story is real. I don't buy that. Massive futures volume does not automatically cancel a physical problem. It just means a lot of price exposure is changing hands. The physical question is a different question. Are inventories loose enough, available enough, and trusted enough to absorb demand when investment flows heat back up? That's where things stop being casual. Fresh industry research says this could be roughly the 6th straight year of structural deficit in silver. Stockpiles have already been drawn down heavily over the last several years. Supply is not exactly roaring higher. And coin and bar demand is showing signs of life again, even while industrial demand has softened a bit under global growth pressure. Think about what that means. You do not need some Hollywood-style shortage where every vault door slams shut. You just need a market that is tighter than it looks, then a fresh burst of demand, then a little volatility, and suddenly the whole thing starts trading like a small doorway with too many people trying to get through it at once. That is how violent repricing happens. Not because every ounce disappears overnight, but because confidence in easy availability starts to fade. And confidence is everything in these markets. Now let's talk about the exchange angle for a second, because this is where people get carried away. There are traders who want some dramatic failure in the system because they think that would instantly hand them moonshot prices. I think that's the wrong thing to root for. You do not need broken plumbing for silver to go much higher. Actually, if the system truly seized up, the first thing you might get is confusion, widened spreads, frozen liquidity, and a market that becomes harder to trust, not easier to cash out. What you really want is a repricing, not a blackout. You want the market to admit the metal is worth more while the machinery still works well enough for you to act on it. That's a huge difference. And from recent market updates, the exchange stock reports remain tight enough to keep traders watching every daily change for available metal inside the system, especially after last year's strain. That does not prove an immediate crisis, but it does mean this is not some bottomless ocean either. It's a finite pool. And finite pools start looking a whole lot smaller when momentum money, hedging demand, and physical interest all show up at the same time. That's why I keep saying silver does not need perfect conditions. It needs pressure, just steady, layered, cumulative pressure. And right now you can see where some of that pressure could come from. One layer is institutional thinking. Quietly, some major wealth desks still see gold pushing back toward the upper 5,000 to low 6,000 zone later this year. Their reasoning is not fantasy stuff. It's the same mix you'd expect. Central bank buying, a softer, longer-term dollar backdrop, falling real rate potential later on, and a world that still looks a little too unstable for comfort. Now, if gold is living in that zone, silver does not have to ask permission to travel. Silver starts doing its own math. And that's when the 100 conversation stops sounding ridiculous. Not guaranteed, not immediate, but reasonable enough that you can no longer dismiss it with a smirk. And there's one more underappreciated support beam here. Official and quasi-official demand has not vanished. Recently published outlooks still point to central banks buying something like 800 tons of gold this year, which is a huge amount of ongoing absorption in a market that is already being treated as strategic reserve collateral instead of just another trade. On the silver side, there are signs liquidity improved after last year's squeeze episodes, but the same research also says the cushion is still thin enough that another wave of volatility, fresh exchange-traded demand, or stronger buying out of India and the United States could tighten things up again. In other words, the market is not frozen, but it is not comfortably loose either. That middle state is exactly where repricing risk lives, because people keep assuming availability will stay easy right up until it doesn't. And once that assumption breaks, traders stop debating theory and start paying whatever the market demands just to secure exposure before the next burst higher. There's another piece here that I think people underestimate, and that is psychology. When gold runs first, a lot of money initially hides there because gold feels serious, respectable, central bank approved. Silver feels rowdier, a little less polished, more dangerous. But once gold has already moved and people begin hunting for torque, silver starts attracting a different kind of attention. That's when percentage chasers show up. That's when momentum desks wake up. That's when retail rediscovers the story. And that is usually when silver begins making gold look almost calm by comparison. You've seen versions of that movie before. Gold opens the door. Silver kicks it off the hinges. Now let me give you the counterpoint, because I always think you should challenge the bullish case while it's getting popular. The risk is not that silver has no story. The risk is that too many people front-run the same story at once, then panic at the first ugly reversal. The other risk is that inflation stays sticky enough to keep policy tighter for longer, which can slow the timing even if it does not kill the bigger thesis. And the other problem, of course, is global growth. If industrial demand weakens more than expected, silver can get caught in that crossfire for a while. So I'm not telling you the next move has to happen tomorrow morning. I am telling you the ingredients are there. That's different. And the macro backdrop keeps feeding the conversation. The national debt is still hovering around the high 30 trillion range. Treasury itself is already showing that interest on the public debt is eating a bigger chunk of federal outlays. Consumers are not exactly feeling flush either. Recent sentiment readings showed a sharp drop, with more people talking about high prices wearing down their finances. Buying conditions for vehicles and durable goods have worsened. That matters because when households feel squeezed and growth confidence slips, the market begins sniffing around for protection again. And protection eventually rotates back toward hard assets, not always in a straight line, but eventually. You can even see it in behavior. People trade down, they postpone the big purchase, they keep the older car another year, they patch the house instead of remodeling it, they watch the grocery bill harder, they get more defensive. And when enough of that starts showing up at once, the big shiny narrative about resilience starts losing some of its shine. That's when gold usually gets taken more seriously. And when gold gets taken seriously, silver tends to start overreacting. Which, by the way, is exactly why I do not think the silver thesis depends on a single chart pattern, a single geopolitical headline, or one magical squeeze event. The case is broader than that. It is a stacked case. Dollar softness, sticky inflation risk, debt service pressure, consumer fatigue, central bank demand, constrained silver availability, ongoing interest in bars and coins, and a market memory that still knows silver can move much faster than people think once it gets loose. That stack is what matters. If you're successful, share your success story in the comments so others can stay motivated. And let me say one more thing that almost nobody says when the excitement ramps up. Even if silver does make it into triple digits, that doesn't mean you abandon discipline. Fast markets create bad decisions. People stop scaling. They stop thinking. They confuse a good thesis with immortality. Don't do that. A bull market can make you money, but it can also embarrass you if you start believing every candle belongs to you. Stay sharp, stay flexible, and stay honest about what the market is actually doing, not what you need it to do for your ego. So where does that leave us right now? It leaves us with gold still rebuilding after a war-driven hit. Silver still holding near levels that would have sounded insane not that long ago. A softer dollar backdrop than we had a few weeks back. Exchange inventories that are meaningful but not unlimited. Fresh deficit concerns in silver, and a macro environment that still leans supportive for hard assets over time. That is not a guarantee of 100 silver tomorrow, but it is absolutely the kind of setup where a move toward that zone can stop being fantasy and start being a serious discussion. And if silver gets there, you already know what comes next. The same people who laughed at the idea will suddenly act like they saw it all along. That's how it always goes. They call it impossible on the way up, then they call it obvious after the fact. So for me, the real alert is not just the price target. The real alert is the change in behavior. Silver is acting stronger. Gold is refusing to die. The dollar has lost some authority, and the broader system still looks fragile enough to keep the hard asset bid alive. That combination can stay quiet for a little while, but when it stops being quiet, it usually doesn't whisper. It shouts. Subscribe if you want more of these breakdowns, and drop John A.G. Best in the comments if you want me to keep going deeper on silver, gold, and the bigger macro picture. And as always, take this as education and market perspective, not personal financial advice. I'm sharing how I see the setup, not telling you what to buy or when to buy it.